Let's talk about the cash you have sitting in your bank account right now. Because whether you realize it or not, you're in a silent war. A war against the value of your own money, and honestly, every single day you do nothing, you're losing. Think about it. At current rates, $100 today could feel more like 80 bucks in just a couple of years. So what we're gonna do right now is put together a real battle plan to defend your savings. First things first, we've got to understand the battlefield. The number one problem is that just holding on to cash is a guaranteed loss in today's economy. A lot of people get worried about the stock market's wild swings, and they think, hey, parking my money in a savings account is the safest thing I can do. But what they're missing is this other, sneakier risk, the slow, steady bleed of what that money can actually buy. This phrase right here, it sounds harsh, doesn't it? Savers are losers. But it's so direct because it captures the brutal reality of what inflation does. Just imagine this. As more and more money gets printed and pumped into the system, all those new dollars are chasing the exact same amount of stuff. This is what pushes prices up on everything. Your groceries, gas, rent, you name it. And it means every single dollar you've worked so hard for buys a little less today than it did yesterday. And this just lays out the cold, hard math behind the problem. On one side, you've got the interest your bank is paying you, and let's be honest, it's often less than 1%. But on the other side, you've got inflation chipping away at your money at a rate of 3.6%. So here's the kicker. Your money isn't just sitting still, it's actively going backward. You are literally paying the system over 2.5% every year for the privilege of holding your own cash. It's crazy.
Okay, so the problem is crystal clear. Keeping your money in cash is like trying to fill a bucket that has a hole in the bottom. But that leads to the next huge and often totally paralyzing question. If not cash, then what? This is what we call the investor's crossroads. And frankly, with all the screaming advice coming from every direction, it can feel like a really confusing place to be.
Right? This is exactly it. You hear it all. One person is telling you to jump headfirst into the stock market for massive growth. Someone else is yelling gold. Gold is the only thing that's real. And then, of course, you've got bonds, which have always been pitched as the safe and sensible option. With all that noise, how in the world are you supposed to figure out a clear path to actually protect your money without getting completely overwhelmed? All right, let's start with what we can call the engine of growth, and that's the stock market. But it's so important that we think about stocks in the right way. They aren't just little flashing symbols on a screen. They represent real ownership in actual productive businesses. We're talking about companies that make things, sell services, and innovate. Owning a piece of that is the classic way to fight inflation by owning a piece of the economy that is actively growing. And would you look at this? The history here is incredibly telling. Over the last 60 years, and think about everything that happened in that time, wars, recessions, crazy financial crises, stocks have delivered an average return of 7.1% per year after factoring in inflation. Now look at bonds over that same period, only 2.1%. That is a massive difference. Over the long haul, stocks have beaten bonds by a ratio of almost 3.5 to 1. That's huge. So when we talk about stocks, we often mean growth stocks. And all that really means is you're investing in companies that are making more money faster than inflation is eating it away. They're taking their profits and pouring them back into creating new things and becoming more valuable. The bottom line is, you're not just holding some passive asset. You're betting on human ingenuity and our ability to create and grow. Okay, so stocks are our growth engine. But what happens when that engine sputters, right? When the market gets scary? This brings us to the great debate over so-called safe havens, which we can think of as our engine of protection. So let's take a hard look at the traditional places people run to when they're scared and see if they're really as safe as they seem. Gold. It's the first word that pops into so many people's heads when they hear inflation. I mean, for thousands of years, whenever people have lost faith in paper money, the go-to move has been to buy this shiny yellow metal. It's seen as the ultimate, tangible store of value. But is it really the protector that it's cracked up to be? So the argument for gold is actually really simple and powerful. It's a defensive move. The whole idea is that when the value of a dollar is falling, gold, because it's a physical thing that you can't just print more of, is supposed to hold its value. And yeah, we've seen this play out. When people get nervous about inflation, they often flock to gold, and that can drive the price up. But, and this is a huge but, here comes the powerful counter-argument, made famous by people like Warren Buffett. Gold is what's called an unproductive asset. It doesn't earn anything. It doesn't pay you dividends. It doesn't invent a new product. A kilo of gold today is, well, it's still going to be a kilo of gold in 100 years. As Buffett puts it just sits there and looks at you. Meanwhile, an investment in something that produces things, like a farm or a company, has historically created way more wealth. All right, now let's talk about the other big piece of the protection engine, bonds. The best thing about a bond is its predictability. You lend someone money and they promise to pay you back a fixed amount over time. That sounds wonderfully safe and cozy, right? Well, the problem is that fixed stream of money is also a bond's greatest weakness when inflation hits. That $100 you get back down the road is going to buy way less stuff than the $100 you invested today. So we've got a growth engine in stocks that can feel way too scary, and a protection engine in gold and bonds that might not protect you at all from inflation. It's really easy to feel stuck. But this is where we introduce a simple, time-tested blueprint from one of the greatest investment minds ever. See, it's not about choosing one engine over the other. It's about building a vehicle that uses both of them at the same time. This whole strategy comes from the philosophy of the defensive investor. The term was coined by Benjamin Graham, who was actually Warren Buffett's mentor. A defensive investor isn't trying to get rich quick or hit home runs. Their number one goal is just to avoid big mistakes, protect themselves from the unexpected, and, sleep well at night. It's about winning the game by simply not losing it. And here it is, the heart of Graham's strategy. A dead simple 50-50 split. That's it. 50% in high-quality bonds, which are basically just loans to super stable governments or big companies, and 50% in leading common stocks, which for most of us today just means a simple, low-cost S&P 500 index fund. It is the perfect balance of that protection engine and the growth engine, working together. Now here's the secret sauce that makes this whole thing work. It's not just set it and forget it. You have to follow a simple, almost mechanical rebalancing rule. The goal is to always keep that 50-50 balance. So let's say the stock market has a great year and your stocks grow to be 55% of your portfolio. You just sell that extra 5% of stocks and move the cash over to bonds. This simple little action forces you to do what is so emotionally hard for us to do. It forces you to sell high and buy low, automatically. It's all logic, no fear or greed. So why is this simple little plan so incredibly powerful? Well, for starters, it gives you a built-in defense against all the market craziness. But most importantly, it acts like a seatbelt. It restrains you from making the most human and most dangerous investment mistake, getting swept up in a hot market and piling more and more money into stocks right when they're at their most expensive. It's a simple rule that makes sure you take some profits off the table and stay balanced, all while making sure you still get to participate in the long-term growth of the economy. Look, this 50-50 split is a powerful, simple starting point for anyone who wants to survive and even thrive through inflation. But Graham himself said that split could change. Maybe it's 25-75, maybe it's 75-25, depending on your age and how much risk you're comfortable with. The key takeaway here isn't the exact number. It's the principle of balance itself, of combining that growth engine with the protection engine. So the real question to leave you with is this: what's the right balance for you to finally win your own silent war on savings?